Hey, JJ here with the Art of Value. So today I'm going to talk about inflation and specifically the views between hot off the press Jerome Powell, what the latest he said about inflation, and Cathie Wood, Cathie Wood, active ETF manager with ARK Invest, and Michael Burry, what he's been tweeting about inflation. So the general views of inflation between those three. And let's see what Jerome Powell says. Of course, he's not an investor. Fed Chair. Let's see what he says.
I think on Friday said that the number one risk to the U.S. economy is that the Fed could overdo it because inflation could come down as quickly as it went up. Is that really possible?
Well, we'd certainly welcome inflation coming down more quickly than expected, and we would take that into account in our policy. So as I mentioned earlier, we're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive, and as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly, there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability. And what Augustine was speaking to earlier, a low inflation environment or regime is what we've had, and that is one in which inflation is low and no one pays any attention to inflation, and that's called rational inattention because it doesn't matter. When there's a big inflation spike, if it's going to go away, we would ignore it and sort of play through it because it'll go away and it won't affect people's understanding. But to the extent there are a series of shocks, it does become rational for people to pay more and more attention. And I think the clock is kind of running on, how long will you remain in a low inflation regime where most of the changes in inflation are actually idiosyncratic as opposed to broadly across the macroeconomy. So the risk is that because of a multiplicity of shocks, you start to transition into a higher inflation regime. And our job is literally to prevent that from happening, and we will prevent that from happening. We will not allow a transition from a low inflation environment into a high inflation environment.
Okay, so they're saying that they will not allow transition from a low inflation environment to high inflation. So remember they said it was transitory, inflation was transitory until it wasn't. Then the war started, so supply chain issues pushing inflation up. Said it was temporary, turning out not to be temporary, longer than they thought. So they're doing everything they can to get inflation down. He also said today, I see that the market's quite aligned with what the Fed is doing. So presumably they're okay with the bear market and emerging tech stocks coming down a lot. So they're okay with that. The market's aligned with what they've been doing. But Paul Krugman saying that there's a danger they could go too far. Economist Paul Krugman, who writes for the New York Times, I think. And so there's a danger of that. But so this is what Jay Powell thinks. They're trying to get it down. They think they'll achieve it. And they're trying not to. They don't want it to run. Definitely don't want it to run away. So let's just hear a little bit of commentary on that.
Inflation while also keeping employment at the well levels that we're seeing right now. Take a listen to what he said with regards to the possibility of a soft landing from earlier.
There's no guarantee that we can do that. It's obviously something that's going to be quite challenging, and I would also say that the events of the last few months have made it significantly more challenging. Thinking there particularly of the war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder. The pathways have gotten narrower. Nonetheless, that is our aim, and we believe that there are pathways to achieve that.
So not necessarily a great thing to hear the pilot go on the intercom and say the pathway is getting a little bit narrower on that soft landing. But look, with the...
Okay, so they're talking about a soft landing for the economy. That's what they're trying to engineer. So they're raising rates to try and bring down inflation. This is my understanding. That's no advice. That's my opinion. Rising rates to bring down inflation at all costs because they do not want kind of systemic inflation like the 1970s situation. But he's saying the window's narrowing for not having pretty much a hard landing, meaning recession. But some people think it's in a recession, including Cathie Wood, saying we're already in a recession. I think so too. I think the numbers that come out over the next quarter probably say that it's in a recession, but that's just, I don't know, it's my opinion. Let's see what Cathie Wood has to say about inflation because it's interesting.
being driven by powerful new technologies.
Cathie, one broader question and then a specific stock question. When you think, though, about the last year and you think about your approach, what is the lesson in it? Meaning, I know you have a North Star about specifically these stocks that you're talking about, but at some level, you have to look around. And I think your investors would want you to look around and say, okay, I was wrong. What was I wrong about? And if I was wrong, how am I going to change my approach in the future?
Oh dear. Okay, so yeah, putting the hard word on her there about saying, obviously her funds are down hugely, and so what did she say?
If we were wrong on one thing, and that was inflation being as sustained as it has been. Supply chain, I can't believe it's taken more than 2 years, and Russia's invasion of Ukraine, of course, we couldn't have seen that. So inflation has been a bigger problem, but I think that it has set us up for deflation. I've been listening to your program. I heard Ken Langone talk about being in recession now. Jeremy Siegel, same. We think we're in a recession, and we think a really big problem out there is inventories, the likes of the increase of which I've never seen this large in my career, and I've been around for 45 years. And we're talking about the best managed companies in the world. If you're talking about Walmart and Target, they know how to manage supply chain. So if they have problems, we think there are a lot more problems. And then the other thing that's going on is the consumer is railing against these price increases. Consumer sentiment, as measured by the University of Michigan, which we think is the best measure out there, is down to record low levels, below 08-09, below 80 and 81. I had just started my career, and inflation and interest rates were in the double digits, 15, 20%. And consumer sentiment today is lower than it was back then. And most interestingly, in the last report, many people think, oh, the heavy spenders will keep this thing going. Consumer sentiment in the highest income groups is lower than in the lowest income groups, and the latter group is being, tormented by food and energy prices, which are really a regressive tax increase here to them.
Okay, so basically, it's going to be a de-inflationary environment. Interesting, and she's always said that. She said that you're wrong on inflation, that it would persist for so long with the supply chain war. But I'm not sure if she ever said there was going to be inflation very much. I think she said it was going to be transitory. They were surprised by it. And so one more thing. So Michael Burry, he said, this is what he said in his tweets. There's no video. Transitory, no. Peak, no. To the moon. If you mean a cold, dark place. The CPI news this morning was so awful that it changed the bond market's view of the Fed trajectory, and the weakest sector broke. So he's saying inflation will be persistent pretty much, and he's been saying it for a while, that he thinks there'll be inflation carrying on. So the opposite view to Cathie Wood, and he thinks Jerome Powell's the Fed's wrong. So one more tweet. January 1973, President Johnson died. Foreman beat Fraser and Roe versus Wade. The Dow hit its highs for 1966-1982 period as cyclical inflation reduced the spending power of the dollar to just 35 cents. There was never a deflation to reverse that. So he's basically saying it's similar again. Today he talked about, I see a bifurcated labour market developing as unskilled, semi-skilled remain in short supply, but white-collar workers have proven their redundancy during COVID. Will find gross excess in the labour market, pressuring wages at the end. Wages in the end. And there's a picture of Tesla laying off staff. I think it's from their actually auto driving section. So he has been talking in his tweets about a temporary disinflationary with the overstocked retailers, but carrying on after that. So that's the gist, really. He's saying kind of the opposite of Cathie, but saying over temporary. Okay, that's all for now. So if you like this, like and subscribe, and I'll see you tomorrow. Join me on Twitter at The Art of Value.